The top business stories live from the Sky News City studio. The US Federal Reserve leaves interest rates unchanged, with the Bank of England widely expected to do the same when it announces its latest policy decision at midday. I'll be joined by some of the city's top investors as the Edelman Smithfield Summit kicks off at the London Stock Exchange. Plus, I'll speak to the Chief Executive of Currys as shares of the UK's biggest electrical goods retailer rise despite a small drop in sales. Good morning. Welcome to Business Live with me, Ian King. We begin today with interest rates. In around half an hour's time, it's widely expected that the Bank of England will announce it's making no changes to the current 5.25% bank rate. Last night, though, the US Federal Reserve gave its strongest indication yet that it will begin cutting interest rates next year. It led to the S&P 500 hitting its highest level since January last year, while the Dow Jones Industrial Average hit an all-time high. The Fed held its main policy rate, Fed funds, at the current 22-year high of between 5.25% to 5.5%. But the accompanying commentary made clear that officials expect Fed funds to finish next year at between 4.5% to 4.75%. Well, joining me now in the studio is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, good to see you this morning. I mean, equity markets loved this. The Fed is clearly a little more dovish than expected.
Yeah, they were very excited to see Powell really acknowledge the fact that rates are likely to come down next year. There had been some expectation coming into the meeting that he would maybe push back at market expectations, because markets in the last couple of weeks have really been pushing to bringing forward the date of the first cut and also having a fairly aggressive move downwards. And he really didn't push back that much. It's important to say, though, that whereas the Fed is expecting or projecting 75 basis points of cuts, the market is still expecting a lot more than that. It's about 130 to 150 basis points being priced in. So I think there's some room for disappointment early next year, but I think the key message for equity markets, for investors everywhere, is that the hiking cycle is finished and 2024 is going to be the year of the pivots.
So what does Wall Street think it knows that Jay Powell and the Fed don't?
Well, it's interesting because historically the Fed usually only stays on hold for about 3 to 4 months before it pivots. But typically it pivots because economic data has also weakened, as well as, of course, inflation being close to target. So I think from our perspective, and maybe from the Fed's perspective, is that they are still expecting the economy to be fairly resilient through the first half of next year. And then it's only once you start to see a bit of a slowdown that maybe the door opens for those rate cuts. So I think that's where the difference is. But really, we're just talking about a couple of months.
Yeah, it's interesting. I mean, looking at your notes, the comments you've been making today at the event, I mean, you still think the US faces a number of challenges next year.
So we are expecting them to see a bit of a consumer slowdown. We know that they've been very resilient to date, but excess savings are starting to fade. You're going to have to deal with maybe higher mortgage payments, corporates having to refinance. But I don't want to exaggerate the downside here, because actually this is still a very, very resilient economy. We're expecting a slowdown, but not a recession. And I think that's really the key thing. How
critical, though, is this issue about corporate debt refinancing in particular?
It is fairly important. So let's say we were to see a very strong US economy next year, inflation pressures take off again, and the Fed cannot reduce interest rates. That would be a concern, because corporates are really coming up for their refinancing through 2024 and into 2025. So I think one of the ideas out there, which is why markets are so positive, is that corporates can almost move past the rate cuts, or the rate hikes, and really start thinking about rate cuts.
And obviously we do have this issue, as you say, US consumers are coming under more strain. It feels as though, unlike over here in the UK, they've kind of burned through their pandemic savings.
That's right. I mean, you know, they did see an incredible move up, so to about 2 trillion worth of excess savings, which is something we have never seen before in any kind of downturn. But, you know, you've seen time, you've seen inflation, you've just seen higher costs everywhere, and that has meant that excess savings have fallen. But importantly, this is really key only for lower income households. Your higher income households have enjoyed an increase in wealth over the last few years because of equity markets, because of house prices. So actually, it's really only on the margin that you're going to see a consumer slowdown. It's not a cliff edge, it's more of a downward slope.
And briefly, Seema, what are you looking out for from the bank at midday?
So a similar message, no more rate hikes, and maybe a little bit of tentative conversation about rate cuts starting in 2024.
All right, Seema, got to leave it there. Great to see you this morning. That's a really busy day for you. It's good to see you. Thank you.
Good to see you.
Some other business news stories for you now. And the FTSE 100 distribution giant Bunzl said this morning that full-year operating profits would be slightly ahead of expectations. Bunzl, which supplies packaging materials, safety equipment and cleaning and hygiene supplies, said this was despite lower COVID-related sales and reduced benefit from inflation. The company, which employs 21,000 people around the world, said it expects sales to increase in 2024 thanks to both acquisitions and its growth in its own existing businesses. The shares are ahead currently by 1.5%. The outsourcing group Serco said today that results this year will be better than expected, thanks partly to strong demand in both the UK and Europe for its immigration services. Serco provides housing and support for asylum seekers in the community and operates secure detention services on behalf of government immigration departments. It announced today it's buying European Home Care, a leading private provider of immigration services in Germany, for €40 million. The shares have risen by more than 5%. And Thames Water has appointed the former chief executive of the emergency power supplies provider Aggreko as its new chief executive. Chris Weston led the FTSE 250 company for 7 years, having previously headed the international downstream arm of Centrica, the parent of British Gas. Well, the appointment of Mr Weston, who takes up the role on the 8th of January, comes just 2 days after Thames, the UK's biggest water supplier, told MPs it does not currently have the funds to meet a £190 million debt payment due in the spring. Now, shares of Currys have surged by more than 10% this morning after the UK's biggest retailer of electrical goods said profits for the year would be in line with expectations. Currys, which makes most of its sales in the second half of its financial year, was reporting an adjusted pre-tax loss of £16 million for the 6 months to the 28th of October. That was down from £17 million in the same period last year. It also flagged an improvement in profitability at its previously troublesome Nordics operations. Well, joining me now, I'm very pleased to say, is Alex Baldock, the Group Chief Executive of Currys. Alex, welcome to you. Looking at the results, your UK and Ireland like-for-like sales were down 4% in the period. Is that largely down to pressure on household budgets?
Good morning, Ian. The UK consumer is quite hard-pressed, yes, and we've seen that reflected in a market that's still very tough. At the same time, the UK has shown some really encouraging progress for us as a business. We've kept profits stable underlying in a really tough environment. And importantly, our gross margins have continued their forward march. The third year in a row that gross margins have advanced as we've done a better job of selling services to customers as well as selling products. And also we've kept our costs tightly controlled. So we're quietly quite pleased with the continuing momentum that we're seeing in the UK business, despite what continues to be a tough consumer environment.
This point on services is absolutely fascinating. You know, a lot more people are buying care and repair services from you. Does that have implications for the product replacement cycle?
It's interesting. We want to benefit either way, and we want to help customers either way. If customers want to buy a new product, we're definitely going to be there for them. And as you know, 80% of UK consumers are Currys customers. At the same time, we want to be every bit as famous at Currys for helping customers give their tech longer life. If they want their tech traded in and repaired and upgraded and recycled. We now have over 9 million repair customers in the UK. And clearly from a sustainability point of view, as well as from an affordability point of view, customers can see the benefits of repair. So we want to be big in both new and in repair. And of course, the business makes money both ways.
You also make the point in the statement that a lot more people are buying using credit with you. What proportion of purchases is now financed partly or in full through credit?
We've just broken the 20% adoption rate. We're at 20.3% now of our sales are on our own credit product. That's up over 3 points year on year. Now, we think that's good for everybody. That's good for customers. Our customers can afford the technology that they want and need with the assistance of our credit. And credit customers' net promoter scores, their satisfaction, as they stated, is significantly higher than for non-credit customers. But of course, it's good for us as well. Credit customers are stickier and they're more valuable. They're much likelier to come back and shop with us in the following 12 months, and they tend to spend more. So we think credit, as with so many things that we go for, is a bit of a win-win for the consumer as well as for Currys, which is why we're happy to see it continue to grow.
You don't worry about possible delinquencies?
We worry about that a lot. I mean, one of the reasons that we're able to continue growing credit at this stage of the cycle when other people are having to pull in their horns on lending is because we've been so prudent and so careful over the years. We could have grown our credit book much faster, but we partner with BNP, a pretty prudent and conservative bank. That's how we like it. We want to stay a mile away, not just from causing customers real losses, but the reputational damage that would hit Currys if we were associated with lending money to people who can't afford to pay it back, which is why we don't. We've been really careful about lending money to people who can afford it, and we do all the affordability and creditworthiness checks that you would expect. And the reward for that is that we're able to continue to grow the credit book even at this stage of the cycle.
Now, on the investor call today, Alex, you've had some quite strong words for the government, not least for the fact that they've just hiked the minimum, the national living wage, while at the same time offering no relief on business rates.
Yes, I have. And it's that combination that you refer to, Ian, that's the issue for the UK's largest private sector employer, which is retail. Now, it's important to break it down, though. At Currys, we're certainly not complaining about paying our colleagues more. We pay our frontline colleagues 37% more than we did 5 years ago. It's part of our world-class colleague engagement. We absolutely need happy colleagues to have happy customers. So we're not complaining about that. It's for retail as a whole, for retailers who are less strong than Currys, who are less able to swallow these big cost increases, and having both at the same time, with a big spike in the national minimum wage, but then this £500 million increase a year on year in the rates bill that's headed retail's way. And it's simply counterproductive. The government says it wants to reduce inflation. This is going to be inflationary. These costs are going to be passed on to consumers. The government says it wants growth and jobs. This is going to dampen both in the UK's largest private sector employer. There's still time for Jeremy Hunt to reconsider the rates rise. We urge him to reconsider that.
Before I let you go, Alex, what's Christmas looking like? What are going to be the big sellers?
Well, customers are still treating themselves, Ian, and you can be on that list too. So customers are treating themselves at home. Fewer people are going out to eat, and that's good for air fryer sales, particularly the big new dual zones. People are spending more of their entertainment budget in home. That's great for console sales and AAA games such as Call of Duty. People are also spending less on expensive hairdresser appointments. 2/3 of consumers are saying that, and that's also good for hair tech. So we'd expect to see all of that together with the usual suspects of A-rated appliances, Windows laptops, mobile phones, especially the new formats of flip and foldable. So there's a lot going on in the space, and there's still time to get those presents pre-Christmas.
All right, well, best of luck with it all, Alex. I know it's a busy day for your results day. We do appreciate you sparing the time to chat. Thank you.
Thank you. Thank you.
Well, the US dollar has hit a 4-month low this morning after the Federal Reserve signalled that US interest rates have peaked. As you can see, sterling is up by more than 1/3 of 1% against the greenback, slightly lower against the euro. The single currency, meanwhile, up nearly 0.5% against the dollar. On the equity markets, well, Wall Street threw a party last night after the dovish statement from the Federal Reserve, but stocks were mixed overnight in the Asia-Pacific region. The Nikkei in Tokyo fell by nearly 0.75%, following a rally in the yen. In Europe, those stocks are all trading to the upside this morning. The CAC 40 in France and the DAX in Germany have both touched all-time highs today. You can see them on the screen there now. The CAC 40 up 1.25% just now. Features include Vivendi. The French media group is ahead by some 8% on reports of a possible three-way demerger. Well, here in London, the FTSE 100 has hit its best level today since the 22nd of September. It's currently ahead by just over 2% in a broad-based rally. Among the leading gainers is Ashtead, the plant and tool hire giant. Big exposure there to the US housing market. That is one of the top gainers in the FTSE, while the gaming group Entain is ahead by another 6.5% following yesterday's management changes. Outside the FTSE 100, well, we just mentioned Currys. They're among the leading gainers, while a clutch of property stocks are also trading positively on the back of the Fed's interest rate commentary. They include Great Portland Estates, Safestore, which is ahead by nearly 7%, and Crest Nicholson, the house builder. As for the oil price, well, that's continued to claw back some of the losses it racked up on Tuesday. Barrel of Brent crude currently changing hands at $75.61 a barrel. That's up nearly 2%. Well, all day today, the London Stock Exchange is hosting the Edelman Smithfield Investor Summit, gathering the city's top investors to chew over some of the big themes that they expect to see next year. Well, we've already heard from Seema Shah, who's already spoken at the event, and joining me now is Vivek Paul. He's Global Head of Portfolio Research and UK Chief Investment Strategist at BlackRock Investment Institute. Vivek, good to see you this morning. I mean, obviously the big theme next year is going to be this transition from a high interest rate environment to one in which they're falling. How will you position yourself for that?
I think the context really is crucial here. You talked about the falling rates, but they are still sizably higher than we have been used to for a generation. And in particular, when you think about the United Kingdom and you can think about where our own neutral rate of interest might be, whatever cuts we see is still likely to end the year with the rates kind of materially higher. And I think that's the key thing for 2024. It's this environment where we need to get used to a regime of higher rates as standard, higher volatility. And I think when we're thinking about building portfolios around that, it's less about the sort of static one and done allocation, like me telling you that this is going to be great or that's going to be great for the entire year. It's more about being dynamic, because as you've seen in the last couple of days, how quickly markets can move on macro data, and positioning around that, being dynamic around that, that's the key thing for 2024.
Yeah, so you're going to be much more active in managing your portfolio. So clients often get a bit antsy about that because implicit in that is higher costs.
Yeah, let's be clear about what I'm talking about here. I'm talking about more dynamically managing the overall portfolio. I'm not talking about particular products or whatever else there might be. And the point I'm making here is that this is an environment where you go back to the sort of the last decade or so, and that was an environment where actually sort of setting and forgetting a portfolio was kind of hard to beat, actually, in an environment where rates were just going down. Actually a stable allocation of equities and bonds, really hard to beat. This is an environment where actually you see huge rallies or declines in yields or spreads or whatever else there might be. And I think that's what we're saying. We're not saying that, everyone being more dynamic is automatically going to benefit, but actually if you have some ability here, you can kind of add expertise. I think this is a more fruitful environment.
So you've really got to appraise your asset allocation more
Absolutely.
regularly, right? I mean, you're also talking about mega forces that are going to influence decisions. What do you mean by that? What sort of things you have in mind?
So we're talking here about sort of structural dynamics that might kind of cut across asset class boundaries. Rather than saying equities are going to do this, bonds are going to do that, we need to think about the impact of things like AI. Think about the things of like the climate transition, aging populations. These are dynamics that will play out across different regions, geographies, and asset class boundaries. And I think understanding that, I think, is really crucial. We think many of them contribute to why inflationary pressures might continue to be a bit stickier in the long run than people are giving it credit for now. But the thing to kind of think about in the very near run, one of our key views is around AI, something that we've been sort of leaning into over the course of the last half year. We think that still has room to run.
Just to go back on something you just said there, you think inflation could remain stickier. Is that down to the tightness in labour markets?
I think that's the key part. So the point being that, this is an environment where, supply constraints more broadly, thinking about labour, for instance, are just at a different level than they have been for a long time. If you think about the last 30 to 40 years, we had female participation increase materially, China entering the global workforce, things that effectively made the cost of building things cheaper or doing things cheaper. That is not the environment we're in now. Geopolitical dynamics, which is another of the structural megaforces, these are pushing the inflationary pressures a little bit greater than we've been used to. And I think these are the dynamics which mean that actually the path down is a bit bumpy, particularly in the UK, than maybe would have been assumed in the past.
Now, obviously, next year also, we have a lot of elections around the world. The United States, India, the world's biggest democracy, Russia, probably here in the UK. Is that going to potentially create problems for asset managers?
I wouldn't say problems, more that I think it's a contributor to broader volatility in the environment that we've talked about already. And I think one of the things that I think is really interesting when you think about the next year, often we focus on the idea of the impact of the elections on markets. But the impact of markets on the elections, I think, is also quite interesting in a certain way. I think this UK campaign that we're likely to see is very much in the shadow or the overhang of the events of 15 months ago and the previous Prime Minister, and markets effectively placing the UK in the spotlight. And I think what that means is the sort of the central pledges made by the government and the opposition are a little bit more towards the centre ground than they have been in the past, because markets can react in quite a big way. So I think that's the thing to look out for. Our stake at this moment in time is it's being fought more from the centre ground, and therefore, as a result, whichever side kind of comes out on top is less of a market move than might have been this time last time.
Vivek, there's loads more I wanted to ask you, but we're out of time, I'm afraid. Thanks for coming in today.
Thank you.
Still to come here on Business Live. Could investment abroad by UK pension funds be stunting economic growth at home? Don't go away.
one of the two unusual meteor showers of the year, because most meteor showers are associated with comets, the debris that comes off icy bodies as they fly close to the sun. These are associated with an asteroid, and in this particular case, an asteroid called 3200 Phaethon. And the unusual thing about this is because these are very bright meteors when they come through the sky, very bright indeed, very yellowish in colour, and they look very different in many cases to the usual wispy type of things we get. And because it's associated with an asteroid, people have been wondering how on earth the material came off. A paper published just this year suggested that what we're looking at is a rocky comet rather than an icy comet, which had a catastrophic failure when it flew close to the sun and broke apart, forming 3 asteroids, one of which is Phaethon. And the orbit of Phaethon is really bizarre because it's a very elongated orbit, takes 500 odd days to orbit the sun and gets really close to the sun. So therefore all the ices that would have been associated with the comet have actually burned away, leaving just this rocky debris which comes off, we think caused by sodium bubbling just underneath the surface. Go out into your garden.
What time? Any time?
I would go in any time after midnight, but it's usually best between 2 and 4 a.m, weather permitting, of course. Look to the darkest
When
part.
I'm on my way to work.
Yeah, look to the darkest part of the sky. If you get away from street lights, all the better, but we have no moon to interfere, which is brilliant for us at the moment in time. And just lie back and enjoy it. Get a nice cosy chair out, get some warm clothing on, a nice warm drink, and allow 20 minutes for your eyes to adapt to the darkness. That's really important. And you should actually see the shooting stars flying over your head. You'll see a shooting star. I mean, the pictures on the captions, which you've got behind you, are quite correct. So you'll see a sudden streak of light going across the sky. And as they're really quite bright, they'll be brighter than the normal little ones you see. So you might even see some fireballs with a bit of luck.
Fly Emirates. Fly better. Fly Emirates. Fly better.
Thank you.
Welcome back now to the Edinburgh Smithfield Investor Summit. And this year has seen a lot of soul searching among UK investors as a clutch of big companies have moved their main stock market listing from London to New York, while the UK chip designer Arm Holdings opted for New York on its return to life as a quoted company. There's also concern that UK pension funds are not investing enough in UK equities and thus holding back the ability of UK businesses to support economic growth. Well, there are a few people better equipped to talk about this than my next guest, Gervase Williams, one of the most renowned investors in small cap companies. He's head of equities at Premier Miton Investors. Gervase, good to see you this morning. Now, you're posing the question, will 2024 mark the end to the UK funds using the piggy bank to fund international assets? What do you mean by that?
Yes, I mean, what we've seen is globalisation. It's very much favoured the companies which are growing rapidly, particularly US companies. US stock markets massively outperform the UK market. And so we've seen every time there's been an opportunity to invest in a new asset class, basically local investors have shaken the piggy bank, sold a bit of local investments, invested perhaps in NASDAQ, more recently perhaps in the bond market. And that's led really to their weightings reductions, but most particularly ongoing sellers. So the valuation in the UK has come down, valuation in the US is up, and we're in a massively kind of recovery potential.
Now, you've said this morning you think the UK has the potential to be one of the world's best performing stock markets next year. Is that because of valuations being so depressed?
Yes, in part, but it's actually more to do with the nature of the UK market. It's different from the US. We've got capital-intensive businesses. Capital-intensive businesses, when cash it gets more free, when you've got lower cost of capital, lower cost of interest rates, effectively it becomes more and more competitive. As interest rates start to go up, of course, then it's become less competitive. So go to 2022, you did see that period, the UK market was the best performing of all. If you take it since, say, something like September 2020, the UK stock market is pretty much the best performing stock market of the world. We just don't talk about it enough.
Now, you're obviously a small cap guru. It should be no surprise that you think the outlook is particularly sunny for UK small caps.
Well, it's quite controversial, really, because actually small companies have actually really suffered, particularly in the last 3 years. There's been indexation trade. It's favoured bigness, globalisation, mega caps in the US. So actually small caps have become even cheaper relative to a UK, which is cheaper. Now, what we're seeing already is that many of these companies are trading well. The share prices have come down. And so the opportunity for them not just to have a catch-up trade, but actually to continue to grow if there's a global recession next year is so much better for small companies. I think they'll be the best performing part of one of the best performing stock markets in the world.
Well, this is going to be music to a lot of viewers' ears. I mean, it is astonishing, some of the valuations, some of the premia that we've seen takeovers taking place at. It shows how bombed out a lot of these stocks were.
And actually, many of these don't represent good value. I mean, they might be 100, 150% premiums to the share prices before, but many of these companies were just ridiculously valued to start with. And even after the takeovers, they're still not expensive. So actually, better to not accept the takeovers, retain your quoted company, get the share prices up, and use the capital to buy assets from the receiver, particularly at a time when there may be a global recession. Then you can actually enhance your growth rather than just get taken over.
Have you had situations then over the last 12 to 24 months where some of your portfolio companies have received bids and you've been really reluctant to accept the offer?
Yes, I mean, just about every company which has been taken over in our portfolio for the last 5 years, they've asked us to sign irrevocables. We say no. Sometimes they say, well, don't worry, the deal won't happen if you don't sign the irrevocable. Not a problem for us. And then those deals still go ahead. And once the deal's on the table, other people accept it. Unfortunately, the inevitable happens at that stage. So yes is the answer. We've been actually very cautious about taking takeovers because the upside is so much more significant if you just stay in the companies for a bit longer.
Yeah, people should be really angry about this, shouldn't they? I mean, this is value being left or potentially being taken off the table that would have accrued to the investors.
Absolutely. But more importantly, actually, local companies generate skilled employment. They particularly generate better productivity improvement. And ultimately, if they succeed, they pay the local exchequer. If they become part of a bigger international company, of course, many of those advantages are lost.
Now, you've mentioned this move towards large caps and indeed to international stocks. A lot of talk still in the city about MiFID II, which was the EU directive blamed for killing off research in a lot of these smaller caps. Is that still a factor?
Well, Rachel Kent's come up with her proposals, and they've actually taken many of those features away. And so actually that's beginning to unwind. In fact, I was speaking to her recently, and she's actually really fired up about not just dealing with MiFID, but actually raising the profile of UK quoted companies. Specifically, these are innovative, younger companies, more immature, and all of these features are actually going to be features you might need if the global economy becomes flatter because interest rates remain higher for longer. Not necessarily at this level, but actually, inflation may be a bit of a long-term problem.
All right, Gervais, it's good to see you. Haven't had you on the programme for quite a while. It's nice to see you again. Thank you.